Welcome to today's deep dive on the Bulls, Bears, and the Bell podcast. I'm so glad you're tuning in with us. It is Monday, August 10th, 2026. And, if you just glance at the surface numbers today, you might think the market simply took a nap.
Yeah, it really does look like a summer snooze on the surface, but that calm is incredibly deceptive.
Right, because last Friday was this champagne-popping, record-breaking week on Wall Street. But today, investors are suddenly hiding their money in gold bars and small-cap domestic stocks.
Exactly. We are looking at a market that is just grappling with two massive, totally opposing forces right now.
Okay, lay them out for us.
So on one side, you have a cooling labor market, which usually makes investors really optimistic about interest rates finally stabilizing.
Sure, the classic good news is bad news, or bad news is good news scenario.
Right, exactly. But slamming right into that optimism is just a massive wall of escalating geopolitical risk.
And that is exactly what we are going to decode for you today. We have a stack of fresh post-market research reports tracking the closing numbers, the specific sector movers, and all the after-hours earnings from today's session.
Yeah, there's a lot of aggressive money movement to track.
Definitely. We are going to look at how capital is, frankly, fleeing legacy tech, flowing into tangible commodities, and just sprinting toward the new frontiers of space and AI.
It's a huge structural shift.
Yeah, it really is. So let's start with the macro picture just to establish the baseline. The S&P 500 finished essentially flat today, down a fraction of a percent, just 3.10 points, to close at 7,754. The Dow Jones took a slightly harder hit, losing about 140 points, and the tech-heavy NASDAQ dropped 62 points to 26,628.
Which, all sounds like standard low volatility consolidation after Friday's record highs.
Just standard profit-taking.
You'd think so. But the real story is in the one index you haven't mentioned yet.
Ah, right. The small cap index, the Russell 2000. It was literally the only major index to end in the green today, up about a point.
Yeah.
Now, on the surface, a tiny fractional gain doesn't sound like front page news. But in the context of the Dow and the NASDAQ pulling back, that divergence is pretty glaring.
It's huge.
So are we just seeing traders lock in profits on the mega caps, or is there like a structural reason why institutional money is suddenly favoring the Russell 2000?
Oh, it is deeply structural. And it comes back to that geopolitical risk we mentioned earlier.
Okay, how so?
Well, think about the mega cap giants that dominate the Dow and the NASDAQ. Your massive tech and industrial conglomerates, they are multinational, right?
Right. They're everywhere.
Exactly. They rely on incredibly complex, really fragile global supply chains. So when tensions flare up internationally, those supply chains are the very first things threatened.
Because if a shipping lane is blocked or, a tariff is suddenly imposed, a multinational corporation's profit margins get squeezed instantly.
Precisely. They are highly exposed to the world stage. But the companies in the Russell 2000 are predominantly smaller domestic businesses.
Oh, I see.
Yeah, their manufacturing, their supply chains, their customer bases, they're mostly contained right here within the borders of the United States.
So when global anxieties spike, money managers look at those domestic small caps as an insulated safe haven.
Exactly. They are essentially buying a shield against international supply chain disruptions.
That is fascinating. And that structural vulnerability of the large caps is actually a perfect pivot to what dragged the NASDAQ down today.
Yeah, there was a very specific anchor weighing on the technology sector.
Right. It wasn't just broad, vague anxiety. It was a legacy titan. Intel, ticker INTC.
Oh man, Intel took a significant slide today, and it sent a very clear ripple of anxiety through the rest of the legacy tech sector.
The catalyst for that slide was their announcement of a $15 billion stock offering.
A massive number.
Massive. And, for anyone listening who doesn't spend their free time digging through corporate finance filings, let's break down the mechanics of why the market absolutely hates this.
Yeah, let's do the soup analogy.
Yes. Okay, think of a company's total underlying value like a giant pot of soup. If you own shares, you own a bowl of that soup. When Intel announces a $15 billion stock offering, they are essentially taking a massive gallon of water and pouring it straight into the main pot.
Right. And while there is technically more total volume in the pot, the nutritional value and the flavor of the soup you already hold in your bowl is completely diluted.
You haven't gained any actual substance. You just have a watered-down asset.
Mathematically, what happens is the company increases the total supply of shares trading on the open market.
So the earnings are spread thinner.
Exactly, because earnings are divided by the number of shares outstanding, Every single existing shareholder just saw their slice of the profit pie get smaller.
Wow.
That is the literal definition of earnings dilution, and it is a really bitter pill for investors to swallow.
But I want to dig into the why here. I mean, a company like Intel doesn't just dilute its shareholders for fun. A $15 billion capital raise is a huge move. Why do they need that much cash right now?
Because they are fighting a tremendously expensive war for survival.
Over foundries, right?
Exactly. Intel is trying to transition its entire business model to build out new, cutting-edge semiconductor foundries. Building a single modern chip fabrication plant, a fab, it costs tens of billions of dollars.
And they are currently trailing behind their competitors in this space.
Big time. So this massive stock offering is essentially a distress signal. It tells the market, hey, we need a staggering amount of cash immediately just to stay relevant in the new era of computing.
And that is why it spooks the rest of the sector.
Right.
When institutional investors see a foundational pillar of Silicon Valley struggling to keep the lights on without watering down its stock, they start interrogating the rest of their portfolio.
They start looking for other weak links.
Yeah, they start wondering which other legacy tech companies are secretly drowning and about to ask for a $15 billion life raft.
And it accelerates a rotation. You have to remember, capital is ruthlessly efficient.
Always.
When a sector looks vulnerable or requires just too much capital expenditure just to tread water, the smart money leaves. It looks for better risk-adjusted returns elsewhere.
Which brings us to where that money actually landed today. Because capital doesn't just evaporate, right? It relocates.
It always finds a new home.
And according to the post-market data, a massive chunk of that fleeing tech money rotated directly into the energy sector, specifically crude oil.
Makes perfect sense. When a digital economy looks shaky and global tensions are high, capital flees to the physical world. It seeks tangible assets.
Crude oil prices were edging higher throughout the session today, and traders are hyper-focused on the Strait of Hormuz.
Yeah, that's the big choke point.
Now, the reports crossing our desks suggest that Iran is in the final stages of a new transit deal via Oman. On paper, that sounds like geopolitical de-escalation.
On paper, sure.
So why is the crude oil market still trading with such incredible anxiety? Are commodity traders just assuming these diplomatic reports are entirely fabricated?
It isn't necessarily that they think it's fabricated. It's about how commodities traders calculate risk premiums.
Okay, break that down.
In diplomacy, final stages is a very dangerous phrase. I mean, it could mean an agreement is signed tomorrow, or it could mean negotiations completely collapse next week and take 3 years to restart.
Right. A verbal agreement doesn't fuel a cargo ship.
Exactly. The Strait of Hormuz is the single most critical choke point for global oil transit. We are talking about millions of barrels of oil passing through a highly volatile corridor every single day.
So the traders are just doing the math on the worst-case scenario.
Yeah, they apply a mathematical risk premium to the price of oil. They're basically saying, we will remove this premium when the ink on the treaty is dry and the tankers are flowing freely without naval escorts.
But until then, they pay up.
Right. Until that physical reality is achieved, they price in the absolute worst-case scenario.
Trust, but verify by buying crude just in case.
Exactly.
And we are seeing that exact same defensive posture in the precious metals market today. Barrick Gold, ticker symbol GOLD, reported their earnings before the bell.
And they had a solid beat.
They delivered a very steady earnings beat. But it seems like their corporate performance is almost secondary to the underlying commodity they mine, considering gold itself is up a staggering 7% just this month.
Gold is fascinating because it is the ultimate barometer for systemic anxiety.
It really is.
Think about what we've discussed. A cooling labor market at home, major tech titans diluting their shareholders, and tension in critical global shipping lanes. Gold thrives in that specific environment.
Because it's completely disconnected from all of that.
Yes. It doesn't pay a dividend, it doesn't have a CEO to make bad decisions, and it doesn't rely on a fragile supply chain. It just exists.
In a market where everything feels complicated and fragile, a shiny rock that just sits in a vault is highly appealing.
It is the ultimate non-correlated asset. When investors are afraid of what they don't know, they buy what they do know.
But, you know, the market isn't a monolith, and not everyone is playing defense right now.
Not at all.
While one faction of institutional money is hiding in gold and domestic small caps, another massive wave of capital is sprinting aggressively in the opposite direction.
Ah, the growth frontier.
Yes. Our research identifies this as the space and AI supersector. And what stands out to me in these reports is that investors are no longer treating space and AI as two separate industries.
No, they're morphing into a single intertwined ecosystem.
It's wild.
It is a profound structural convergence. You really cannot build the future of AI without the infrastructure of space, and you cannot conquer space without the computational power of AI. They just feed off each other.
So let's look at where the dollars are actually flowing. On the private and secondary markets, the dollar volume interest in SpaceX is just astronomical.
Pun intended.
Exactly. But on the public markets, retail and institutional money alike are surging into companies like Rocket Lab, ticker RKLB.
Yeah, Rocket Lab is a massive focus right now.
And we have a slate of after-hours earnings tonight that traders are watching intensely. AST SpaceMobile, ticker ASTS, reports after the close, and everyone wants an update on the operational timeline for their first 5 satellites.
Right.
And Rocket Lab is also reporting, with the street demanding updates on their launch frequency and the development of their new Archimedes engine.
The reason the market is so obsessed with a company like AST SpaceMobile is because of what those satellites actually do.
Which is what?
They are building a space-based cellular broadband network.
Okay, but why does that matter to AI?
Because artificial intelligence requires unimaginably vast amounts of data to function. Space infrastructure, these low Earth orbit satellite constellations, it's becoming the ultimate data highway.
Oh, wow. So they're building the roads for the data.
Exactly. It allows massive data transmission globally, completely bypassing terrestrial borders and physical cables.
And the flip side of that symbiotic loop is the rocket companies themselves.
Yep.
Because you can't manage the logistics of a reusable rocket or optimize a launch trajectory or process the telemetry data of 1,000 satellites without advanced artificial intelligence.
It's a perfect feedback loop. The market sees this, and they are pouring capital into the companies building this new physical infrastructure.
Which is why the development of Rocket Lab's Archimedes engine is so highly scrutinized tonight.
Right. If they can increase their launch cadence, they lower the cost of accessing space, which just accelerates the entire AI data highway build-out.
But, every massive growth narrative eventually hits a reality check. And I want to pivot to the hardware side of this AI boom.
Yeah, let's talk about the hardware.
Supermicrocomputer, ticker SMCI, officially reports earnings tomorrow. But today, right at the end of the session, the stock saw some really wild volatility.
Over margin compression fears.
Exactly. For our listeners trying to spot the cracks in the AI gold rush, how does margin compression actually work in this specific context?
This gets to the very heart of the difference between the physical constraints of hardware and the infinite scalability of software.
Okay.
So, Supermicrocomputer builds the physical servers that house these incredibly powerful AI chips, like the ones NVIDIA makes. Margin compression is just a math problem.
Because the parts are getting too expensive.
Exactly.
I agree.
It means the underlying components to build those servers, the chips, the specialized liquid cooling systems, the raw materials, they're staying expensive or even increasing in cost.
But they can't just pass all those costs onto their customers forever.
No, because competition in the server market is fierce. If Dell or Hewlett-Packard decides to undercut Supermicro's final price just to win market share, Supermicro hits a pricing ceiling.
So their costs are high, but their sales price is capped.
Right. The profit margin in the middle, their slice of the pie compresses. It shrinks.
Which hurts the stock.
Right.
Yeah.
It doesn't mean AI is a fad, but it does mean the era of printing easy money in the AI hardware assembly business might be facing some very serious headwinds.
The hardware just gets commoditized over time.
Exactly.
Now, contrast that brutal physical reality with the software side of AI. Look at Palantir, ticker PLTR. They continued their massive upward momentum today, building on a 30% rally from last week, fueled by their quarterly results.
Palantir is a perfect example.
The market seems to be realizing that while building the physical server is a low-margin knife fight, the software running on it is a totally different business model.
Software has zero marginal cost of reproduction.
Meaning once it's built, it's free to copy.
Exactly. Once Palantir spends the money to build and train their underlying AI architecture, they can sell that exact same software license to the U.S. military and then turn around and sell it to 100 different private corporations.
They don't have to buy 100 physical motherboards to do it.
Right. The cost to deliver that second copy is virtually zero.
Which means the profit margins on software scale infinitely. And that explains why institutional money is rotating so aggressively within the AI sector itself.
They are hunting for the highest margins.
Precisely. They are moving away from the physical constraints of server assembly and toward the unlimited margin potential of AI software and space telemetry.
It's all about where the leverage is.
Okay, so we've mapped out the high-flying momentum of AI and space, and the defensive, geopolitically driven reality of gold and oil.
A tale of two markets.
Truly. But to really understand how institutional money operates, we need to look at a sector that trades on an entirely different set of rules. Let's look at biotech.
Biotech. Always a wild card.
Specifically, Gilead Sciences, ticker GILD. Gilead traded completely flat today. It closed exactly at $132.56.
Not a penny more. Not a penny less.
Now, the research notes indicate that the stock is compressing tightly against its 100-day exponential moving average, or EMA, as traders wait for a clinical breakout.
Yes.
What exactly is this EMA, and why do traders care so much about it?
So an exponential moving average isn't just a random line on a stock chart. It is a weighted mathematical formula. Unlike a simple average that treats every day equally, the EMA gives significantly more weight to the most recent trading days.
So it reacts faster to breaking news.
Exactly. It reacts much faster to current sentiment. Institutional algorithms and technical traders use the 100-day EMA as a baseline to determine the long-term trend of a stock.
So when a stock like Gilead is sitting exactly on that line and barely moving a few cents in either direction, what does that actually tell us about the psychology of the market?
It tells us we have reached a total stalemate.
A tug-of-war with no winner.
Right. The buyers and the sellers are perfectly deadlocked. Neither side is willing to commit capital to push the price away from that historical average.
And in the biotech sector, this happens for one specific reason, right?
Yes. They are waiting for a binary event.
A binary event meaning a clinical trial result or an FDA ruling. It's a pass or fail.
Exactly. Biotech doesn't care about the Strait of Hormuz. It doesn't care about Intel's stock dilution or the price of server cooling systems.
It's in its own little world.
Completely. It trades purely on scientific outcomes. Gilead is sitting on that 100-day EMA like a coiled spring.
Just waiting.
The algorithms are programmed and waiting. The moment that clinical trial data is released, if it is positive, the stock will gap massively higher. If it fails, it will drop like a stone.
It really highlights how multidimensional the market is. You trade AI on future growth metrics, you trade oil on geopolitical risk premiums, but you trade biotech on these massive binary scientific coin flips.
Which is why you can never just look at the S&P 500 being down a fraction of a percent and assume nothing happened today.
Never.
The market is an ecosystem of capital, constantly searching for the most efficient home based on completely different sets of rules.
And that brings us to the core takeaway of today's deep dive. When you watch the evening news and they tell you the market was flat, you are missing the entire story.
You're missing the undercurrents.
Today was defined by a massive structural transition of wealth. We saw the legacy guard, represented by Intel, literally diluting its own value just to survive the cost of modern innovation.
We saw serious geopolitical anxiety forcing a structural rotation into tangible physical safe havens like crude oil and gold.
While the multinational megacaps were left totally vulnerable.
Right.
And we saw the undeniable aggressive pursuit of the new frontier. Capital flowing into AST SpaceMobile, Rocket Lab, and Palantir proves that the market is willing to pay a massive premium for companies that control the infrastructure of the future.
Understanding these undercurrents is how you spot where the global economy is actually heading, rather than just where it has been.
Exactly. It's about following the money and not just the index points. And I want to leave you with one final provocative thought to mull over as you watch these markets evolve.
Let's hear it.
We spent a lot of time talking about how private secondary markets are valuing SpaceX and how that growth narrative is spilling over into public companies like Rocket Lab.
Yeah, a lot of hype there.
But think about the sheer amount of institutional capital locked up in legacy tech right now. What happens to the traditional public indices when massive, privately held space behemoths finally decide to go public? Oh, wow.
Right. When a company that controls the literal infrastructure of low Earth orbit rings the opening bell, how many billions of dollars will instantly drain out of the old tech guard to fund that new reality?
That is going to be a black hole for liquidity. It'll be the ultimate test of market gravity.
It absolutely will be. The transition is already happening. You just have to know where to look. Keep your eyes on the horizon, and we will catch you on the next deep dive right here on the Bulls, Bears, and the Bell podcast.